Hi, I'm Brooke Thackeray. Welcome to the week ahead for Monday, February the 8th, 2021. Today we're going to take a look at the earnings announcements expected to come out this week. Now, we are past a busy time for the earnings season, but nevertheless, we do have a good cross-section of earnings coming out. Also, we'll take a look at the economic announcements coming out this week and how they might affect the stock market overall. Let's jump right in and take a look at the calendar here. We can see here that on Monday we do have Lowe's reporting, Hasbro. Then on Tuesday we got Cisco. Now, Cisco was the darling of the tech boom back in the late 1990s. Hasn't been doing so well recently. It will be interesting to see how they report. Twitter, DuPont, Coca-Cola, General Motors on Wednesday here. General Motors will be interesting because if you take a look at General Motors on an absolute basis, you can see the stock in 2017, 2018, or late 2017, 2018, 19, and into 2020 was flat. You know, it had a few squiggles here and there, but it really didn't move around very much. It fell down, obviously, with the pandemic, and it's rallied since the bottom of the market in March. And this second panel here is relative, the price relative to the S&P 500. You can see here that it's late 2017, 2018, 2019, and into 2020 has underperformed the S&P 500, found a base as the market was reacting to the risk-on mode starting in late March. And then when the market really went risk-on into October, we saw a strong outperformance of General Motors overall relative to the S&P 500. Now, it's also because General Motors has been coming out with positive announcements on their expectations of electric vehicles in the future, and investors really like what they've heard. So it'll be interesting to see what they report this time around and investor reaction to that, because it has been a little bit of a company that has had quite a bit of interest from investors throughout the recovery from the pandemic as a recovery takes place. Also, too, as well, if we take a look, we got on Wednesday Great-West Lifeco. Then on Thursday, we have Disney. It's going to be interesting to see their comments on their theme parks and also the travel business. Duke, PepsiCo, Kraft, Brookfield Asset Management, Kellogg, Tyson Foods. Tyson Foods is going to be interesting because they're a restaurant food supplier business, and obviously with the pandemic, that side of the business has not done well because restaurants have a lot of them been locked down, and a lot of them have been constrained as far as numbers go, and also to the extra costs that go along with servicing in the pandemic times as well. So we've seen underperformance here since 2019, September 2019, relative to the S&P 500. We have seen a little bit of a stabilized base here as well. So Tyson is actually an interesting company to watch, because when we start to see strong outperformance of Tyson relative to the S&P 500, that could indicate that investors actually believe that we're moving somewhere closer back to normal, or at least they see that in the future as well. So the announcement on Thursday could an investor reaction to that announcement could provide some valuable clues as far as that goes. On Friday, we do have Enbridge as well announcing, and also Fortis. And Fortis, and this is, if we take a look at Fortis here, this is on the Toronto Stock Exchange, and this bottom panel is relative to the S&P TSX Composite Index. You can see here this rally that took place in early 2020 as investors said, look, the pandemic's starting to roll out here. We want to remain invested. They went into companies such as Fortis, which is a utility company with a high dividend, and Fortis actually did very well relative to the market. But once the market moved to risk on, we saw this underperformance take place. And then recently, as interest rates have ticked up again, we've seen underperformance take place as well. But this pattern of this outperformance spike, and then this retreat when the market went risk on, is also very similar to what's taken place in the consumer staples sector. So we've seen this a shift into the defensives in early 2020, and then we've seen a continual shift away from them since March of 2020 as well. If we take a look at the economic announcements coming out, we do see on Monday, we do see the consumer inflation expectations of 3%. Now, in this case here, you can see that 3%, as far as the expectations go, is been fairly steady from the consumer side since May. So although inflation expectations on the investor side are different, on the consumer side, they've been fairly steady around 3%, which is higher than the CPI. And so consumers are saying, hey, we're expecting inflation to be higher than what the CPI is actually coming up with. And if we take a look at on Wednesday, we see the core CPI coming in. The expectations are for 1.6%. Now, in this case here, let's take a look here. Last report was 1.6. The forecast is 1.6. And we've seen around this level, 1.6 for the last few months overall, despite all the money printing that's going on and government spending. So a lot of investors are going, hey, look, it's fine. There's no consequential effects or no externalities taking place or negative consequences from money printing. We can see more money printing to help programs in society and government to spend more money without any real costs at all. But that may not be the case in the future overall. Now, in this case, this is the core CPI. I have to make that clear. And so this excludes oil and food as well. So it excludes energy and food. And because they tend to be volatile components of the inflation measure. Now, those are the two components that have actually been moving up. So the core, although it's interesting, may not be the best measurement right now as far as inflation expectations in the future. If we take a look at, let's just go back here. Well, we'll skip forward actually. Actual year-over-year inflation. So this does include energy and food as well, coming in at 1.4%. The expectations this Wednesday on that is to be reported at 1.4%, which is very similar as well to what's happened over the last few months. So despite all this money printing going on, the inflation really hasn't been affected so far. In fact, you've had several Federal Reserve governors coming out and saying, well, 2%'s okay, we can do 2%. In fact, 3%, we could live with the 3% as well. So they're really starting to try and push up that inflation narrative as well. But there could be some problems down the road, maybe in a couple of years, who knows when that could take place, with all the money that's being introduced into society and government spending as well. And if we take a look here, this is investor inflation expectations, and this is using the Federal Reserve data on a five-year forward expectations rate. And so this is just using swaps in the market to determine investor expectations. We can see here that on a 5-year basis, so what investors expect inflation to be over the next 5 years, it has been ramping up over the last number of months. And this has really been part of that reflationary trade where investors are saying, look, you know what, we think inflation is coming back into the economy, and they've been coming back into some of the sectors that typically do well in that environment, some of the cyclical sectors as well. So we've seen investor in expectations constantly ramp up over this time. Now, we have seen a little bit of a pullback recently on the reflationary trade where the cyclical sectors actually underperformed in the month of January. Now, on a seasonal basis, that often happens in January where you find the cyclicals underperform, but they tend to find their footing in late January into February as well, and perform quite well into May. Now, I wanted to show you this graph. This graph has been on the internet for quite some time as well. This is also from the Federal Reserve as well. This is the money velocity, how frequently a dollar turns over in the economy per year. And you can see here that since the late 1990s, we've seen money velocity actually going down. But once the pandemic took place, we saw this real down move taking place here as far as the money velocity goes. And so this has also given the Federal Reserve some room and the government to actually introduce more money into the economy overall, because the velocity has been decreasing, and so therefore we haven't really seen an inflation effect taking place. In fact, if you take a look here, you can see here that this is the money stock in the U.S. economy. We can see here that it ramped up substantially through to actions from the government and the Federal Reserve as well. So this week is all about the inflation and how investors are going to react to that, because the reflationary trade has been a big trade in the fourth quarter of 2020. Investors really grabbed onto that inflationary mode. Their expectations for inflations really went up as well. As I said, we did see that pull back on some of the reflationary trade in January, but this week, with these numbers coming out for CPI, if we do see a higher inflation coming out than what we've seen in the past weeks and past months, and also to higher than expectations, it'll be interesting to see investor reaction to that, because if all of a sudden now the reflationary trade really kicks in once again, and we could see that trade actually carry forward over the next few months as well. And even if inflation goes down a bit and the investors react positively as far as the reflationary trade goes, it will show the legs for the inflationary trade coming up. So it'll be interesting to watch the sectors, the cyclical sectors of the market, and how they respond to the inflation CPI announcements this week. Thank you very much for joining me today. Thank you.